Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday 24th October 2025, and joining Derek to pose some questions on the financial market themes for the week ahead is Shan Husain in FIFX Sales. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hello, welcome Derek, and welcome to our listeners.
Indeed. Afternoon, Shan.
Let's start closer to home today. Obviously, we had the Prime Minister Takaichi speech delivered in the Diet today. So if you could touch on that, but also more importantly, we have Trump visiting Japan Monday to Wednesday, and following that on Thursday we have the BOJ meeting. So there's a lot of events lined up vis-a-vis Japan. So if you could please shed some light on those, it'd be great.
Yeah, for sure. It's a busy week. We, like Dollar Yen, got up to close to the post-Takaichi leadership election victory level, 153.27. We got up above 153 again after that, just after that speech, actually. We've drifted a little bit lower on the back of the CPI print, which was weaker, but markets look to be kind of reassessing the extent of that weakness at the moment. So the dollar's kind of coming back a little bit as we speak. But yeah, in the context of dollar yen being up around 153, the next week is pretty important. In terms of the Takaichi speech, there were elements in there that would certainly indicate more fiscal spending is definitely coming on a scale that will be pretty notable. Takaichi spoke about containing debt growth within economic growth, which you could read as, debt can go up as long as the economy is going up more. So it's kind of a read of, okay, this could be more substantial. But she mentioned, other comments about the fiscal policy being strategic, conservative, or careful. So we're still a bit unclear, but definitely there's going to be more spending and very likely more JGB issuance. Overall, JGBs finished down a touch on the day. We had inflation as well, which was moved higher, but the core rate was weaker than expected. So a lot of kind of cross currents, I guess. The key takeaway I would emphasize to listeners is that the speech from Takaichi did not include any reference to the sales tax cut on food, which is an Ishin party demand, or certainly it was going into negotiations. Now, maybe that's been parked for a year or a later date, but it certainly wasn't mentioned in the speech today. And I think that helped to contain JGB yields because that's a fairly expensive component. And if that's been excluded and we're more focused on measures to bring inflation down to help households and more strategic investment into sectors like defense, which would obviously be a positive in terms of the US-Japan relationship with Trump coming, as you said, next week. I think all in, then the markets can absorb this. But, the supplementary budget, there's reports that it could be similar to last year. That was just under 14 trillion. There was about 6 to 7 trillion of new JGB issuance. So, if we're in or around the same kind of plan, that's what we could expect. I would certainly expect a good portion of that issuance to be at the front end of the curve, and indeed in T-bills. So in that sense, it shouldn't have too much negative impact on the super long end of the curve. But of course, we do need to get the details. We need to get a sense of the size. But I think if it's in or around the ballpark of last year's fiscal plan and that level of issuance, with the issuance being focused at the front end of the curve, we should get through without any further notable disruption in JGB market functioning. Just on an aside of that, we did get JSDA data, which tells us, again, domestic investors were seller of super long JGBs. lifers, Citibanks. The trusts were the only buyers of domestic super long bonds. The main buyers, again, were foreign investors. So it certainly indicates, super long end of the curve, foreigners remain the primary buyers in recent months. But yeah, from a yen perspective, there wasn't too much reaction to the Takaichi speech. And then next week, I would imagine the Trump Takaichi meeting, it'll be about defense. I'm sure there's going to be part of that fiscal plan will be to boost defense spending more than what's already currently planned. That will obviously help from a relationship perspective, as I said. And I certainly don't think Japan would want sharp yen depreciation in the context of Trump being in Tokyo next week. So yeah, I would say we should be relatively contained at these levels. The US CPI print, as I've mentioned, isn't screaming for higher dollar yen, although there were some, we'll maybe talk about that in a moment. And then the BOJ meeting on Thursday, obviously they're not going to hike rates, but I think there's enough there for them to give a similar message than before, that ultimately they can raise rates if the economy continues to unfold as they expect. So yeah, a lot to get through next week.
Yeah, no, thanks. Thank you for the insight into that. And you did just mention about US CPI, and that's a segue into my next question. Obviously, we have the FOMC coming up, and with the recent US dollar sort of strengthening, could you shed some light into what the data means for the FOMC coming up?
Yeah, well, I think obviously the first most important point is that going into the print, the market was fully priced for 225 basis point cuts. And the report itself, yes, definitely on the weaker side in terms of the headline and the core, 0.1 of a percentage point weaker than expected. And the real takeaway was the scale of slowdown within the rental component. So owner equivalent rents increased by just 0.1% month on month. You have to go back to COVID when the contribution from OER was as small as it was in today's report. If you exclude COVID, you've got to go all the way back to 2013. So a big downward impact from the weak rental component. But if you look at goods inflation, there's definitely evidence there of tariff-related impacts on goods inflation, up 0.5% month on month, the same as last month. If you exclude food and beverages, goods inflation up 0.7% after a 0.5% last month. So the evidence is there, but the headline remains well behaved because services inflation has come down and eased so notably. So as I said, takeaway, no change. The market's expecting the Fed still to cut twice. Obviously, the CPI report all in allows for that, even though we do have evidence there that the goods inflation is being impacted by Trump's trade policies.
Thank you. So moving on to the big question, Bank of England, and obviously we had a lot of data released in the UK. What are the prospects for a rate cut in November versus December following the data? But also an important point would be the MPC composition and how it might, impact the swing in the decision making at the BOE.
Yeah, there's 6 basis points priced for in cuts for November, 16 basis points for December. The yield is up today, 2 basis points on the back of the data we've had today. Definitely no getting away from the data today. Retail sales was stronger than expected. GfK, consumer confidence print, again, better than expected. And the PMIs stronger than expected. So from an economic perspective, things are looking definitely better than they were. But while the gilt yield is up 2 basis points today, it's down 8 basis points this week. And I think that tells you that the data, in terms of the inflation data, is much more important. And, the Bank of England had been predicting the peak would be in September for inflation, but that peak would be 4% rather than the 3.8% that we got. Also, food inflation has been one of the drivers of shifting MPC thinking into being more cautious, because food inflation is very important for wage agreements and for basically household inflation expectations. Food inflation dropped from 5% to 4.5%, and the Bank of England had been expecting 5%. So it does definitely change the level of concerns about domestically generated wage growth because of food inflation, kind of circling back into stronger inflation going forward. So all in, we've been calling for a December rate cut. We think the inflation data is the most important, and that definitely backs that up. Don't forget also, between the November and December MPC meetings, we've got 2 CPI reports and we've got 2 employment reports. So lots of data to get through in between. And as long as the peak in inflation, as I said, so we should be seeing further declines in inflation over those 2 months of data, which should, I think, set us up for a cut in December. The composition actually might not take much of a swing, because don't forget, it's divided already. We've got 2 voting for a cut, Dingra and Taylor. Ramsden has a history of a dovish vote, so he could, and I think probably will, swing in behind the other 2. So you could potentially now have 3 that will vote for a cut in November, which means Governor Bailey, if he was to decide, and I don't think he'll swing around that way in November, but if he was then to swing around for the December meeting, he'd probably bring Sarah Breeden with him. She always votes with him. That's what the history suggests. So in other words, it comes down to Governor Bailey if David Ramsden has shifted. So it's pretty tight, and therefore I think if inflation allows, they'll definitely cut in December. So we're 9-10 basis points short of that being fully priced. So I think there's still scope for downward pressure on front end rates and also FX. We're dollar bears, so we've got a long euro sterling trade idea at the moment. But if we're wrong on that, obviously, then it's going to be cable that is the better cross for expressing a kind of a bearish sterling view. But yeah, we've still got that long euro sterling trade idea.
Thanks, Derek. We'll keep an eye on that call, and obviously keep an eye on all the central bank action coming up. But no, thank you a lot. Thanks for your time, and thank you for our listeners, and have a great week ahead.
Great, and same to you, Shan.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.